Hi there. A lot of talk lately about the silver market being permanently changed because real metal is getting tighter. Paper traders are acting differently, and physical stackers may finally have more influence than they used to. So, in this video, we're going to separate the powerful part from the dramatic part, and you are going to walk away knowing what has actually changed, what people are exaggerating, and why your physical silver may matter more in the next phase than it did in the last one. Today is Monday, May 4th, New York time, and before we go deeper, comment what day and date you are watching from, because I always like seeing how far this conversation travels. And if you value this kind of breakdown, support the channel by subscribing and comment John A.G. Best if you want sharper, original, useful content without the noise. So, the big claim is simple. The silver market is not the same market anymore. Some people are saying the bull run changed everything, the physical side is taking control, and the paper market is starting to lose confidence. Okay, maybe. But whenever a market story gets that big, we need to slow down and ask what is data, what is interpretation, and what is just adrenaline talking. Because silver can do that to people. It can sit quietly for months, then move so fast that everybody suddenly becomes a genius, then pull back hard enough to make those same people wonder if the whole story was fake. And that is where most stackers get trapped. They think if silver is truly tight, the price must move every single day. But markets do not always work like that. Sometimes the chart looks calm while the plumbing underneath is tightening. Sometimes the spot price is boring while premiums, inventories, delivery behavior, and physical demand are telling you a very different story. So, first let's be honest about one thing. Physical stackers usually do not set the daily price. If you go buy a few tubes, a bar, or some constitutional silver, that may matter to your local dealer. It may matter to retail supply, it may matter to premiums, but it does not instantly move the global screen price. That price is still mostly discovered through futures, options, hedging, institutional order flow, and large market makers. The Futures Exchange describes silver futures as a price discovery and risk management tool, with transparency and oversight built into the system. So, when someone says stackers are now in full control, I would be careful. Not because stackers do not matter. They do. But because silver is not just a coin shop market. It is an industrial metal, a financial hedge, a trading vehicle, and a physical savings asset all at the same time. That is what makes it so interesting. Now here is the part where the physical side becomes important. The standard large silver futures contract represents 5,000 troy ounces, and that means one contract can represent more metal than most stackers will ever personally hold. But a futures contract is not the same thing as a person taking possession of metal. A lot of contracts are opened, closed, rolled, hedged, or used for exposure. Many traders never wanted a bar. They wanted price movement. That is why open interest can sound terrifying if you compare it directly to registered inventory. You can look at hundreds of millions of paper ounces, and then look at a much smaller registered stockpile and say, wait a minute, how does this system even work? And that question is fair. But the answer is not automatically default. The answer is that only a fraction of paper exposure normally turns into actual delivery demand. And even delivery itself can mean warehouse receipts changing hands while the metal stays inside the vault. That is the part people skip. Now, does that mean inventory does not matter? No, it absolutely matters. According to exchange warehouse data from late April, registered silver was sitting a little over 77 million ounces. That is not zero, obviously, but it is not a huge cushion when the paper market is representing far larger exposure. So the correct takeaway is not panic. The correct takeaway is pressure. Pressure can build without the system breaking tomorrow. That is what I think is happening. The market is not dead. It is not magically solved. It is not guaranteed to explode. But the physical buffer looks thinner, and when buffers get thinner, every physical buyer matters a little more. Now let's bring in the demand side, because this is where the story gets stronger. The latest industry estimates show silver moving toward another yearly deficit, with physical investment expected to rise strongly, while industrial demand remains enormous, even with some cooling from substitution and thrift in solar applications. Retail physical investment is expected to reach its strongest level in several years, while recycling is also expected to push above 200 million ounces. That matters because it tells us something very important. And there is another layer here that most hype videos skip. High prices do two opposite things at the same time. They attract investment demand because people see momentum and start paying attention, but they also discourage some jewelry and silverware demand, especially in price-sensitive markets. That means the market can be tight and still have weak spots. You can have investors buying more coins while some fabricators buy less metal. You can have industrial users trying to thrift, meaning they use less silver per unit, while total long-term technology demand still remains very large. That is why the deficit conversation is not as simple as supply down, demand up, price must explode. Sometimes supply rises and the deficit still remains because demand is large. Sometimes recycling rises because price is high, but recycling does not instantly solve everything because scrap has to be collected, refined, and converted back into usable form. And sometimes physical investment demand rises not because people are trying to trade silver, but because they want something tangible when they feel uncertain about currencies, debt, banks, inflation, or policy risk. So the stacker thesis is not just about squeezing somebody, it is about understanding that physical metal has different behavior from paper exposure. This is not just a stacker fantasy. Silver demand is being pulled from multiple directions. Solar, electronics, vehicles, grid upgrades, jewelry, silverware, investment bars, coins, ETFs, futures traders, and old scrap coming back into the system. These are all different lanes of the same highway, and when one lane slows, another lane can speed up. So when people say industrial demand is everything, I would say not quite. And when people say stackers are everything, I would say not quite there either. The truth is that silver is becoming a competition between users. Industry wants efficiency. Investors want protection. Traders want volatility. Dealers want inventory. Refiners want material. Stackers want possession. And the person who has physical metal in hand is participating in the one part of the market that cannot be settled with a keystroke. That is the point. During the earlier squeeze era, retail buyers proved they could create stress in the retail pipeline. Not necessarily by draining the entire world of silver, but by clearing dealer shelves and forcing premiums higher. That is important because premiums are the physical market's warning light. Spot price tells you what the screen says. Premiums tell you what it costs to actually get the thing, and those two do not always agree. If a dealer has to replace inventory at uncertain prices, premiums rise. If demand floods in faster than product can be minted, premiums rise. If people stop selling back and just hold, premiums can stay stubborn even when spot pulls back. That is why physical buying is not irrelevant. It just works through a different channel. Now about the recent margin changes. The exchange's own clearing notice showed silver futures performance bond requirements being reduced from the high teens to the mid-teens area earlier this year. Some people take that as proof the system wanted traders back in the game. Maybe. But here is the counterpoint. A margin reduction by itself does not prove confidence or panic. Margins are adjusted based on risk models, volatility, and clearing requirements. So if traders still pull back after margins fall, that could mean distrust. It could also mean volatility cooled, capital moved elsewhere, or the hot money found a new target. That is why we need to be careful with big claims. Silver can be under stress without every data point meaning collapse. And honestly, we should not want collapse. If the paper market truly broke, price discovery could get messy. Liquidity could disappear, rules could change. The clean fantasy is that silver shoots higher and stackers win instantly. But real markets do not usually reward chaos that neatly. What we want is not a broken market. What we want is a fairer repricing. That is the difference. Now there is one more fresh detail that matters. Recent market reporting showed silver had already pulled back sharply from its January high, with futures still trading dramatically above where they were a year earlier, but far below the top. That tells us the market is no longer in pure mania mode, and that is actually healthy. A market that only goes straight up becomes fragile. Everybody piles in late. Premiums disconnect, sellers vanish, then one reversal shakes out the weak hands. But a market that digests gains, rebuilds support, and keeps absorbing physical demand can be much more dangerous later. Not dangerous today, dangerous later. That is why sideways price action can fool people. They call it boring. Professionals may call it compression, stackers may call it opportunity, the exchange may call it normal trading, dealers may call it a slower week. But underneath, the key question is simple. Who is selling physical metal back, and who is removing it permanently? Because old stackers already removed their ounces years ago. The market had time to adjust to that. New stackers are different. When a brand new buyer purchases silver today and decides not to sell it back, that is fresh metal leaving the active float. Maybe it is small by itself, but thousands of small decisions can become a real drain over time. Think about it like this. If a trader exits a futures position, the exposure can vanish in seconds. If a stacker buys a bar and puts it away for 10 years, that ounce does not vanish from the planet, but it vanishes from available supply. It becomes sleepy metal. It is still there, but it is not easily recruited back into the market unless the price, the emergency, or the owner's psychology changes. That is why old silver matters less at the margin than new buying. The ounces sitting in long-term hands have already been removed. The market has adapted around them, but the ounces being bought today are the fresh change. That is where the physical side can quietly tighten conditions. Now, could some of that metal come back if price goes high enough? Absolutely. Everybody has a price, even people who say they do not. That is another counterpoint worth saying out loud. Stackers are strong hands, but not all stackers are permanent hands. Some will sell into strength. Some will trade gold to silver ratios. Some will pay bills. Some will upgrade from generic rounds into larger bars, or from bars into cash. So physical silver is not a one-way drain. But the more disciplined holders there are, the more difficult it becomes for the market to pull those ounces back cheaply. That is how physical stackers gain influence. Not by overpowering the futures market tomorrow morning, by quietly reducing the metal that can easily come back. And this is why dollar cost averaging matters. It is boring, but it works for the right kind of person. You buy responsibly, you avoid panic premiums, you understand spreads. You keep emergency cash. You know that silver can fall. You do not mortgage your life chasing a headline, because silver is not a guaranteed wealth machine. It is wealth preservation with optional upside. That is a very different mindset. If you buy silver expecting it to make you rich by next month, this market can punish you. If you buy it as long-term physical savings outside the normal financial system, then pullbacks feel different. Sideways months feel different. Premium swings feel different. You are not asking silver to entertain you every day. You are asking it to still be there when paper promises feel less comfortable. If you are successful, share your success story in the comments so others can stay motivated. Now let's pull it together. Has the silver market been permanently changed? I think the honest answer is yes, but not in the cartoon version. Physical stackers are not suddenly controlling every tick. The futures market has not disappeared. Registered inventory is not the same thing as all available silver. Margin changes do not prove collapse. And high open interest does not automatically mean every contract holder wants bars. But physical silver is harder to dismiss now. The deficit story is real enough to pay attention to. Industrial use is still huge. Investment demand is coming back. Recycling is rising because high prices shake loose old material. But that also shows how hard the market has to work to find supply. Warehouse stocks matter, premiums matter, and new stackers matter because fresh physical buying removes metal at the margin. The goal is not to cheer every spike or fear every dip. The goal is to understand whether the physical market keeps absorbing metal while the paper market keeps trying to price it, like there is always more available at the right number. That is the gap serious stackers should watch very closely right now. Patiently, consistently, carefully. That is the real shift. Not stackers taking over in one dramatic moment. Stackers becoming harder to ignore 1 ounce at a time. So if you are holding physical silver, do not let the daily chart control your emotions. Watch the bigger system. Watch the inventories. Watch premiums. Watch demand. Watch how fast refineries can respond. Watch whether people sell back when prices rise, or whether they hold tighter. That is where the next chapter will be written. And tell me in the comments, do you think physical stackers are finally becoming a serious force in silver, or do you think the paper market still has total control? Subscribe if you want the next breakdown, because this story is not finished. This is for education and perspective only. I am not telling you to buy, sell, or hold anything. Your stack, your money, your risk, your timing. Think clearly, move patiently, and never let a dramatic market story replace your own judgment.